Hey everybody, this is Paul doing a late video. I don't know if it's late, but the market is currently closed. As you can see here, it is 6 o'clock Central Standard Time here, and doing a quick video going over the portfolio performance, the different things on the 1st and the 15th, and let's kind of see what we got here. So first thing, let's go over portfolio performance. This does not include today's number. So this pretty much add this in. It's about year to date 14% down compared to the rest of the market. As you can see, it's kind of, I'm basically keeping track with the Dow right now, which isn't the worst thing in the world. So let's see where we're at right here. So right now, as you can kind of see, Fed started raising rates, started talking about raising rates. Market took the first leg down. More news came out about the Fed talking about rates. Market took another leg down, and the market did what it ended up being a bear market rally right here. A pretty big one, as you can see here, from down 5% to up there, so 5% rally. And then you had more really bad inflation data come in. This is in between the Russia and all that stuff. And then we took another leg down, and then we kind of bottomed here, and then where are we at here? So we were down 14%, did another basically 5% up, and as you can see, more rate hikes, more bad CPI reports, and here you go. So this one's about a 3% bear market rally right here. So you can kind of get the general idea where we're headed. There are two conflicting thoughts right now as to what's going on, and I'll kind of show you what's going on. So right now, this is the 10-year historical returns of the 10-year for just different ways that the U.S. government has funded debt going way back when. As you can see, this is the worst drawdown, which means that the most reserves that have been pulled out from various countries and whatnot trying to prop up their currencies. And so effectively what's going on right now is for 10 straight years of basically every central bank in the world has been going in one direction, and it's in the direction of easing. Everybody was talking about Japanification, the idea that you could infinitely just keep supporting these debts and keep issuing debt, and you didn't have to worry about debt, and that wasn't really a thing that you had to worry about. Well, as we've come to figure out, is that there actually is a way that you can kind of get ahead of yourself, issue way more money when everybody's easing at the same time, and everybody has the same response to the same problem. You flood the system with money, and you get worldwide inflation. Not just U.S. inflation, worldwide inflation. Throw in a war on top of that, create an energy crisis on top of a supply crisis, and there you go. So, our Federal Reserve is trying to deal with this. The problem is that you have China that is still in COVID mode. You have the Europeans that are taking the really bad brunt of it. I mean, in Louisiana, for example, gas is $4.30. In Europe, it's close to $10 in some areas. So, we got it bad here. They got it really bad. So, right now, there's basically a lot of countries that are basically selling their U.S. Treasury reserves to try and prop up their currencies, to keep their currencies from getting devalued. And that's what this is right here. Euro to USD, USD to Japanese yen. Right now, the Japanese have gone full blown, just we're going to keep our rates low no matter what. And if it destroys our currency, it destroys our currency in the process. Nobody remotely thinks this is sustainable. So what's different from yesterday? That's today. Really nothing. So right now, what we have going on, you're trying to figure out why the market rally, like what in the world's going on. Basically, the market thinks we're in a technical recession. Technical recession is just a made-up word. It doesn't actually mean anything. Right now, I saved a screenshot. This is actually already out of date from yesterday. This The Atlanta Fed showing that for Q2, they're indicating that we might be down. Right now, they updated it to say even down 2%. So, why are we going into a recession? Why are these words getting thrown around? Well, very simple. This right here, because our Federal Reserve is going one direction very fast, you can see the strength of the dollar has gotten very, very strong over the last few months, while other currencies have gotten very, 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 very weak. Europeans, like the euro, is very, very weak. The Japanese yen is very, very weak. So, what is this doing for us? It's making it very easy for China to import things to us because, you know, China's easing, we're strengthening our currency. So the import number of the GDP number is going to be very big. To offset that, you have to have exports. Well, the problem is when you have a very strong dollar, it kills U.S. manufacturing, just kills it for exports. And then if you have, at the exact same time, consumers that are no longer getting monthly checks that are, doing goods and whatnot, so you have manufacturers that can't export anymore. Plus, you have consumers that are they keep hearing the word recession. It's probably the most searched word on Google right now. You kind of get the general idea of how this kind of starts to start to just have problems. So what we have here is just a few different charts showing how the market is reacting to what we've been on recession watch for probably 6 months. People have been screaming about it ever since the consumer confidence numbers rolled over. Now you're starting to see it more in the data. What that means is basically, so the consumers have basically been saying, look, man, there's something really wrong with this economy, so we're not sure where it's at. Everybody's still kind of doing their thing because you have to eat food, you have to go to work, you have to pay your bills. And they've been trying to work around it. Well, you're starting to see things like high-end RH brands, which is a high-end like furniture type thing. You're starting to notice them put out profit warnings that are saying we're seeing our clients cut back. So those are higher-end consumers that normally, $80,000, $100,000 clients that are starting to cut back on buying large goods. You're starting to see it inside of the car numbers. So the consumer confidence numbers are starting to feed into the overall economy in the form of being cutting back as people have to adjust to inflation caused by the energy crisis and the supply chain crisis. So as you can see right now, the market believes that it's set up to go lower. So this is called the capitulation thing. It indicates oversold. And I just kind of copied this right here. This was basically people trying to figure out, are we at a bottom? Do we have another situation like right here in 2016, 2015, where we had capitulation, but then we rallied and we went to the bull market just continued? Or do we have a situation where it goes down and it keeps going down? As you can see, 2008 it kind of went down a little bit, rallied a little bit, went down even more. It didn't finally bottom until you had a real capitulation, like a double capitulation here, where the market dumped twice, it sold off twice, right here. So is that what we have here? Do we have a situation where it goes up because the Federal Reserve says, okay, we finally have the information feeding through into the economy, the mortgage numbers are horrible, we're seeing demand destruction, inventory destruction, high-end client, we're starting to see profits come down. Does the Federal Reserve say, okay, time to back off a little bit? If you look at the bond market, that's exactly what they think the Federal Reserve is going to do. And you can see it all the way across the curve. You saw it today. The 30-year, it kind of went back up a little bit, but the 30-year almost fell below 3%. It looked like it was kind of heading that way with everybody that was like, whoa, what's going on here? The 10-year had a lot of people buying into it, as you can see there. So right now, the only thing because right now you have the technical recession, so you're going to have 2 quarters of negative GDP. Very good chance we have 2 quarters of negative GDP We're going to find out this month, I believe. I have to figure out the exact day. But so we're going to have our GDP numbers that will let us know, are we in what's called, the theoretical technical recession. Um, so what you're going to be asking yourself, well, okay, you have 2 quarters of negative GDP, but then also you have this. Jobless claims are still at a historic low. They're not really moving. And then you also have employment numbers that are coming in that's still $100,000 jobs added to the company. So that's why it's called a technical recession. That's why people use that word. It doesn't actually mean anything. It's not an official recession until you're actually farther into it. Until you're actually, typically they don't even call it a recession until you're already out of it, and then they look back at the data and go, was the data the NREB or NLEB, but they go back and they look at it, okay, was the data bad enough at the time that we can officially declare this like in a real recession? So that's what that means. You're already out of a recession by the time they even call it a recession, unless it's like 2008, and then it's obvious to everybody. So there's a chance we could literally have two pieces of news. One that says you're in a recession, but then also the very next data point could be 300,000 jobs added to the economy. So what the Federal Reserve is looking for is they're looking for employment to roll over at the exact same time that they see the word recession. So probably a negative employment number. They're expecting unemployment to go up, and they're going to get their wish if they do another 75, another 50, and that type of thing. So they're playing Russian roulette with the U.S. economy right now. There's no other way to say it. So, and as you can see, these are the inflation numbers. They're starting to kind of roll over in the data here. You can kind of clearly see just like a clear peak and a clear, so hopefully this keeps dropping. As you can see from, where are my commodities at? Here's oil. As you can see right here, oil was at 122. So as you can see right here, oil went up to 122 on June 7th and then just tanked. It just can't hold these levels. It keeps trying to hold these levels, 123, and then it just dumps. There's just, no matter, like even with oil plant fires and just everything that's going on, you're still just seeing a lot of issues in the economy right now with basically like they just can't. They're trying to justify these prices at 122, but every time it gets up there, it just completely dumps. Demand just completely falls off. The problem is that at your gas station, going from there to there gets immediately priced in. Going from there to there takes 3+ weeks. This was on June 8th. You're not even going to start seeing this until July 4th. That's how long it takes to feed through into the system, which I hate with such a passion. If you follow me on Twitter, you know I've been extremely angry about this. But so the national average for gas should be under 5 very, very soon. If you're in Louisiana, wouldn't be shocked at that. I think I just saw a gas station that said 414 that I drove by. I don't know what they're putting in their gas, but it was 414. The one down the street was 439 still. So, but that should be dropping below 4 here pretty soon because this is just a dramatic drop and it just has not been able to go back up. They've tried to run it back up and it just can't. It just keeps dumping. So that's where we're at right now on that. Where are we at on the portfolio? As you can see, I was positive today. I was literally positive all day, even when the market was negative. That's because as I've put more into, I went over this last time, as I've put more into this part of the portfolio, it's offsetting anything bad that happens up here. These are more volatile, but these are the bigger dividend payers. If we had zero rates right now and quantitative easing, like money being poured into the system, these would actually be my best performance and my highest dividend payer. So you would get both worlds. But so that's where we're at right now. I'm going to keep adding to these positions here, as you can see. One thing I have started doing, which is kind of funny, I did start doing DoorDash just to earn extra money on the side, just for fun. I'm going to make a video about that as to what that's all about, how I think. It's pretty easy. It's ridiculously easy money. So it makes no sense. How it's just insane how easy it is to make money on that thing, especially if you have a Prius that gets 50 miles at a gallon. Um, it's quite amazing actually, but it's just extra money, and the only reason I'm doing it is so I can literally just pile money into stocks that are my long-term holdings. And it pays out weekly, so what I might end up doing is probably buying maybe 2 shares of Unilever or however much I end up making. Um, Pouring some money into this area, maybe Pfizer or something like that. But I want to get as much out of this market right now as I possibly can, because I don't think prices are going to be at this level for a very, very long time. Because if the Federal Reserve does reverse course, this is the bottom. This is it right here. This is your bottom. But if they don't, we have another leg down. And I did do a goofy little chart to kind of show what that looks like. I literally just copy and pasted this section of the chart because it's becoming kind of predictable. So I made this a few days ago, and I made this about maybe 10 days ago. This was just like a straight up guess. And as you can see, by the middle of July, when we have another Federal Reserve meeting, we could have another dump. And the only reason that we could is because the Federal Reserve could say, yeah, we see that we're in a recession. We see that the numbers are rolling over. We see that the manufacturing numbers are horrible. But we're going to do 75 basis points anyways. And then if they do a press conference that says we're going to stick to the original plan, you could easily see this big drop right here. Like this gain today doesn't mean anything because this could easily just get completely wiped out by the 15th. So everybody, you have to watch the Federal Reserve. That's the only thing you're watching right now to see if they look at it and go, okay, this is not a soft landing. This is turning into a hard landing. This is turning into a very big problem. So that's kind of where we're at right now. So we're just watching. Like I said, my current plan, as I've indicated before, is I think at some point this market is going to very easily go back up. I'll recover this 10% quite easily once this market turns around and then we go back into another bull market. But be aware, we could drop another 10% very quickly. This could go, all of this right here could go down. Snap your fingers very quick. If we start seeing the words recession on the front of every headline, you see the job numbers roll over, you see earnings roll over, you see earnings estimates come down, this market dumps extremely quick. So any money that you put to work, I have to put this as a warning, any money that you put to work right now, be aware it could be down 5% tomorrow, or it could be down 10% tomorrow, or 15%. If you look at Michael Burry, he said we're only halfway through this market downturn, which means that, which is kind of crazy if you think about it. He said we're halfway, so that means another 18%, another 26%, another 14% there. So we could be another 10% down, another 15% down by the end of the year. Maybe that would be enough to scare the Federal Reserve. They have to be getting scared right now because even credit conditions, like the corporate debt market last month had its lightest day in years since the depths of the pandemic when the government had to throw money at it. Like there's some things that are definitely flashing red right now that typically make the Federal Reserve go, okay, this is way too much. So, but just be aware, like I'm putting money in here, but this is excess money. Like this right here, this little bit that I'm putting to work right here, or whatever this number ends up being right here, and whenever I get, whatever little orders I do, this might end up being $200. Every penny I put to that could end up going down 15% from the time I do this video to the time I do the next video. And if you look at it, you can kind of see the pattern. It's a very simple pattern. We get a Federal Reserve meeting, we go up a little bit, everybody thinks everything's okay, then we get another Federal, and then you get more data, then you get more data. The next data to hit is earnings. And if you get a lot of companies saying, look, we don't know where this is going to be, we think it's going to be way worse, we think the consumer is going to be way worse, this market dumps. This market dumps pretty hard. And there's a lot of people that are thinking that 3,200, 3,400 level is kind of where we end up at. So just be aware, this could dump even more. But, if you're investing for the long term, it doesn't really matter. I'm just buying on the way down. I'm buying extremely quality companies at extremely cheap prices, which I don't mind because if you see right here, I bought one share of this and it's already up 15%. This is how oversold we are. This is KB Homes. These are the home builders. I bought this one share right here for $26, already up 14%. Um, so there's definitely some green mix in here of just companies that were just insanely oversold. Um, a 4 on their price to earnings. This is a profitable company that's trading at a 4 PE. Like these numbers are insane. The banks are the same way. If you look at the banks, look at this. An AP on JP Morgan, a bank that's literally too big to fail, that would literally get taken over by the government if it ever did start to fail. Um, One of the most profitable banks in U.S. history is trading at an 8.36 PE with a 3.55% dividend yield. I'll probably end up putting money. I'll take that DoorDash money and probably stick it right here. But that's what I'm saying. Like some of these stocks are just insanely cheap right now, because they've been sold off so much. Home Depot going into hurricane season. There's just a lot of these different ones that are just getting very low, that are just insanely low, that are just like really just screaming buys right now, which is why I started doing DoorDash just for fun, just to get some extra money to throw at these because they're so cheap. So that's kind of where we're at on Recession Watch, and that's what I'll title the video. Just where we're at right now. Okay? Well, thank you so much, and y'all have a nice day. Just leave any comments.